Welcome to Trading Trends. I'm Ilya Spivak, head of Global Macro here at tastylive, and boy, do we have the right guest for a day like today. Todd Bubba Horwitz is with us from Bubba Trading. Todd, welcome. Welcome back.
Ilya, great to be back with you, and it's a pretty exciting, pretty wild day. Pretty wild day to talk.
We're going to need all those 40-plus years of experience here, Todd, because these are markets that are moving fast and things are changing fast. You've been talking about we're looking down the barrel of a 40 to 60% shakeout in the stock market. The hard question, of course, we've been kind of sideways out of a big rally and a very concentrated rally basically since mid-May. Are we topping? Is this it?
It looks like we're topping. I mean, again, I don't like to try to predict exact tops or bottoms. I need the price action to kind of confirm what I'm looking at. But yeah, I could make a lot of case for the markets making a top in here. Certainly, I'm looking to sell rallies right now. I'm not looking to commit to a big long-term short position yet, but I'm certainly looking to be on the short side of the market, even on a daily basis. I mean, we're getting some wild swings. I mean, today you're swinging in the NASDAQ 150 points every 2 or 3 minutes, up and down. So it's really been kind of wild. But when you look at some of the things that push this market up, stocks like Palantir, that's now under 118. You look at the new SpaceX IPO that just came out that got up to 240, which you knew it had to come back down, and now it's sold off back to 150. You know, you've seen NVIDIA start to come down. But the bigger key when you look at those markets is to look at the cheaper stocks, the gamble stocks, the ones that everybody chases after. Most of those have already been cut in half. And that's usually an indication that the big guys are next. And of course, if you look at private credit having trouble, you look at the debt structure that's going on, there's a lot of reasons to believe that these markets are going lower. And I give you one more thing to think about. You now have, at least in Las Vegas, they are now offering no money down for houses and no docks. So once again, if you remember what caused one of the major factors in '08 was, you're starting to see it repeat itself right now.
That is very, very interesting. And I think before we get into the mechanics of what to do here, as you kind of start to move around and go, you know what, the risk reward is starting to look better on the downside, even if we're not going to commit to some sort of big all-in short. Let's talk about the sentiment check here. We were talking in the green room before we started here about the new gold and crude oil contracts coming out, taking down both sides and increasing availability of trading. Talk about that and what kind of sentiment touch point that is in this context.
Well, I think what you're going to see on July 24th is you're going to see crude oil and gold, and they have brand new contracts coming out, a 1 ounce contract in gold and a 10 barrel in crude, but those are going to trade 24/7. Okay, so there's no more weekends off. There's no more not looking at the market. People will be more dedicated, and of course, they're spreading it out in time. And if they want to listen, they want to capture more business. You know, the exchanges that used to be nonprofit before they went public are now profit organizations, and it doesn't cost them anymore to open more hours. And now they can bring in more activity out of Australia, more activity out of South Korea, which are two big markets that want to trade the U.S. markets anyways. So these are new contracts that are going to be coming out because, of course, even though it doesn't cost the exchanges any more money, they want to be able to make sure they can manage the margin. So they're bringing out much smaller contracts, and it'll be, I think, at a much smaller sample size to allow you. There'll probably be some size limits to go with it, but it will be 24/7. And of course, in September, it appears that we're going 24/5 for equities and options at all brokerage houses. And I think by the end of the year, you're going to be 24/7 in all markets. So I think this is where we're headed. I think it's now going into the Bitcoin world and the currencies, although the exchanges aren't open, the currencies trade 24/7. So I think by next year, we'll be 24/7, all markets all the time.
Well, this is music to the ears of somebody that started in Spot FX, as I did, because I'm used to 24-hour liquidity for what I look at. So this is, of course, a very interesting kind of sentiment touch point. Markets are attracting more retail than ever before, and it looks like the exchanges want to service that. It's interesting for that to happen just as stocks are at record highs and start you down the road of kind of thinking about, okay, is this the part where the frenzy starts to be a sentiment indicator and the stampede to participate starts to look like it's confirming a top?
It could be, but I think one of the things you have to remember is when you start to extend out markets and the time that they trade, which really is you're smoothing out the volatility because people don't get a chance to build up that panic overnight or over the weekend. So I think it's going to actually take away some of the volatility. However, because of all the job losses that we're having now, because of all the problems in our economy, you are having more people attempting to become traders. So you're bringing in more volume, and of course the zero DTEs and the SPY and then the Qs and IWM are huge. Now we've got every other day and a number of other securities. I would suggest to you probably sometime within the next year, all of the liquid stuff, the big guys will all have daily expirations because, of course, again, you're going to bring in more players. The more people that lose their job, there is not jobs to replace those jobs. They're going to be looking for places to go. That was the big boom we had during COVID when we brought in a lot more traders. I think you're going to see the same thing now because we're losing jobs at a record pace. I know that ridiculous jobs number they showed a couple of weeks ago was all BS, okay? And if you truly look at it, some will tell you to go look at the U6, which is actually 8.5% unemployment. But the real number is if you look at the employable population versus working, we're at somewhere around 14% unemployment right now.
And that gets us into a conversation about how you actually approach this. So you've been a trader through all kinds of cycles. I mean, obviously, you saw the crash in the late 80s. You saw the 2000 meltdown. You saw the '08 meltdown. How do you position here, right? We can talk about all of the things that go into what would make a market top here, but saying that and seeing it and actually laying out risk to bet on it in a responsible way so as not to get run over by this market, that's a whole other thing. So how are you actually positioning here? What's the way to gain some exposure?
From an investor or a trader?
From a trader perspective.
Okay, because from an investor, I am always 100% long. And
I agree with that.
And I'm always 100% hedged, okay? But from a trader, I think you build your positions. You first have to find which markets you want to be involved in, obviously. Do you want to be in the indexes or you want to pick on individual stocks? So you need to have a reason to get into there. So when you start to see reasons develop, for example, NVIDIA has been pretty weak. So that would be one that I would look at to short. Now, the initial short I would make in a stock like NVIDIA would be to sell some call spreads, partially in the money, partially out of the money. Because I do want to cap the risk if I don't have the timing right. But once I get to that point, I've now built a short position that will also benefit from time. I've created a synthetic put that I'm actually buying cheaper than I could buy on the board. Okay, and at the same time, I have limited risk, limited reward. But if that does start to work out, then I can start to add to that position and turn it into a risk reversal and make it much shorter. And because I've already got a core base built, it's easy to add to that to turn that trade around and make it shorter than it is or flatten it out for a while and then re-enter it again without actually getting out. There's a lot of flexibility you have, especially with NVIDIA, for example, the every other day expirations. So you could actually finance part of that trade by selling spreads daily, Monday, Wednesday, and Friday, against a current position that you have open. So you could actually even sell iron condors against an open position, knowing that if the market tanks, you're going to make money on the short side and lose a little bit on the iron condor. If it goes up, you're going to collect on the iron condor most likely. So it allows you a lot of flexibility with these extra multiple expirations that we have now.
And in fact, selling call spreads is exactly the way that I'm approaching it here. I thought the risk reward was pretty decent in SPY and in the Qs a couple weeks back, and that's sort of how I've started to nibble on this. Let's look outside of stocks because, boy, do we have some moves there. Probably the most eye-catching thing here is the meltdown in crude oil. I mean, we've basically erased the whole Iran war upswing here. Now, what's interesting for me in this context is the war trade started as the market's going, okay, so there's a disruption in oil, that's inflation, bonds go up, dollar goes up, rate cut expectations fall away. Now we're expecting a hike, and we get the new Fed chair, Kevin Warsh, coming out. He was supposed to be a dove, apparently, but that was not what we heard at all last week. And of course, that's not his track record either. We look at this today, crude oil keeps melting, but the dollar is up, gold is selling off, and the bonds are interestingly going the other way. Yields are not going up on this. Square this circle. What's the cross-market action saying here?
Well, first of all, we don't have to everything correlate at one time. Let's start with crude oil. Crude oil had no business going to 120 in the first place. And in fact, I don't know if I did an interview with you, but I did it with somebody. I said that was a selling opportunity of a lifetime. Okay? And not because I'm a genius or anything else, but you knew the way that it spiked up, especially when you weigh into the economic picture. We use WTI here. That has an effect on Brent oil there. We had a glut here. You have a bad economy. You don't have a demand. And I said that you watch when these earnings come out from these oil companies are going to have record earnings. And so far, first one out, Shell Oil, had double their ever record earnings based on this ridiculous pricing. Okay? So I expect crude to continue to fall. I would still be a seller here. And I'm not telling you to go chase it down now. It's down $3.50 today. But I think you want to look for opportunities to continue to sell because I think we're going back to the 50s, which is where we came from. But when you look at the next part of the picture is the yields. Look, we're getting a little bit of a bounce. But remember, the 10-year notes went from just under 4% to just under 5%. There's going to be a little bit of a pullback. Interest rates are going higher. It would not shock me at all is if we saw 10-year notes at 6% by the end of the year, which is a pretty big move, right? But I've been a seller of bonds and notes, not at these levels, higher levels, and you're having a little bounce today. I don't think it means anything. Again, I think we get too caught up with looking at, well, the dollar's higher, so all the commodities should be lower because God forbid that we would make a price adjustment. And of course, people get too concerned into what the dollar's doing. I mean, if you look at the dollar, in the meantime, the grain markets are higher and the dollar's higher. So again, commodities are higher other than gold, and gold's another story. Gold has melted down. Okay, first of all, we had a ridiculous rally. Okay, I mean, it was nice. But you take gold and silver, silver's down 50% from its high, gold's down about 30% from its high. When you get a market that moves parabolically higher, and I urge everybody to go take a look at SpaceX, just not because of the stock, but because of the pattern, you get a parabolic move in either direction, especially in a commodity, which isn't going out of business. Normally the selling becomes greater to the downside or the buying becomes greater to the upside. In this case, it's the selling. And of course, you look at the put market, you look at the put call ratio in GLD, and it's a little skewed. There's a lot of put buying. And I ask you the question, are those people trying to get short that, or are they trying to cover up long positions? Because you always got to know what the other side of that trade is. But overall, I would think that you're coming into an area where gold is coming to probably an unbelievable buying opportunity. And I'm not saying it's today. I'm just saying that I'm certainly would rather be on the long side of gold from here than the short side. I think that you've seen a lot that's going on. There's some big talk of this ridiculous reset and putting out some gold bonds after the July 4th holiday. Listen, a lot of nonsense going on, but it's very simple to understand. People got too long. They couldn't get out. They panicked and they puked them down. And I assure you, when silver was 120, the dealers were only paying about $90 for gold, for silver, because they had too much people trying to sell it. And now people can't get out, so they're selling. And of course, they'll sell into the hole as always. And once again, is it today? I don't know. Is it tomorrow? I can't tell you the day, but certainly I am accumulating and buying physical metals myself right now.
Well, so this then starts to look like an interesting story. And you're absolutely right. The story in bonds has been much more kind of one way and clear cut than the story in stocks. Stocks heard about a ceasefire in April and said, oh, okay, well, earnings are coming up. Okay, goodbye. The bonds have been very consistent. there's a really interesting dynamic here then that happens if gold is somewhere near some sort of a turning point and bonds are starting to turn, maybe, and the economy is on the back foot, maybe. Certainly the growth numbers that we're seeing are throwing up all kinds of red flags here. So when we look at this, are we maybe getting to a place where the market goes, right, so the economy is overheating, this is going to backfire on growth, forget rate hikes, we're going to get rate cuts, but the wrong kind, the kind that tries to fight recession. Is that then a parallel bottom in bonds and in gold at the same time?
It's possible. I mean, again, I don't think the Fed has any intention of cutting rates at this point. But again, you said it, and we talked about the housing market right now and what's going on there. So if we get into another 08 situation, would the Fed have to unload and start cutting rates again? Probably. Hopefully it won't get to that point. But of course, I think that Ben Bernanke panicked when he did it. I think you should have let the banks that couldn't survive go out of business and bail out the depositors. I don't think the American taxpayer is a fan of bailing out billion-dollar banks that make nothing but money except when they have trouble, and then they have the Fed to come and bail it out so they can go create that risk again. I guarantee you that the banks are over-leveraged once again. I assure you that they're far past their fractional banking laws of 10-to-1 of deposit to lending value. And I assure you that many of them are in trouble no matter what the ridiculous moronic stress tests that they tell us about from the Federal Reserve. So I think there's a lot of issues in this. I think we're in a K-shaped economy, which says that only the upper 5 to 10% are doing okay in this economy. Lack of jobs, lack of everything else, and now you have a surplus of housing. You saw the report this morning. But when they start going to 0% down, that means they've got too much inventory. They've got to get out. So what they're going to do is they're going to try to pass it on to the consumer. And who gets screwed when this is all done? It's always the taxpayer, which means that your rate cut theory is very, very viable to happen once again.
Well, I think this is definitely a market that benefits from being watched in a very kind of active way, because things are clearly on the move and things are clearly changing. We talked a little bit about how, as a trader, you would start to think about taking the short side of stocks. Accumulating physical metal is more of an investing idea. If you thought gold was getting ready to some sort of an exhaustion point on the downside, as a trader, how would you formulate that as exposure?
I think you could use, obviously there's a number that you can use nugget, you can use GLD, you can use gold futures, you can use the micros in gold. This is something that depends on what the individual is comfortable with and how they want to handle it. I personally, myself, I'll buy gold futures, okay? I'll go to the futures market because it's a pure market. I don't have to get involved with the implied volatility and the time decay that I have to get involved with when I'm dealing in the option market. So if I'm going to take that position, I'm going right to the metal itself, which is the futures market, either GC or MGC if you want to trade the micros. If I want to build a position, then I would do the same thing using in the options. I would start selling some put spreads, okay, and create a long position in either GLD or in gold itself. They have options on that as well. So again, there's a lot of ways to do it. You have to first measure the risk that you're willing to take, and what is your psychology? What is your stomach for risk, right? How deep can I go? You can't make big money unless you're willing to take some risk, okay? So you have to measure, where are you comfortable? Where is your panic point? If I bought gold right now, if I bought a gold future right now and it went down $100, I wouldn't panic out, okay? But if that's going to make you panic out, then that's probably too big of a position. So you need to build a position in a product that you are comfortable with, the risk that you are taking, and the possible reward that you can make from it.
Well, and that is a interesting approach here. Certainly, the folks here that are listening to us love selling premium. They're gonna love hearing that. And indeed, we've had a little bit of a pickup in gold vol, so there is something to sell there now. And if you wanted, of course, the long side of that exposure, selling puts is exactly what you'd be doing. I'm following your lead. I'm using those 1 ounce gold futures that you were talking about and just putting on Delta One exposure, but those 1 ounce futures give me the opportunity to kind of scale in and scale out in a very granular way and manage that risk that way. Todd, we could talk about this all day long. I hope you'll come back soon and we can check in on how our prognosticating went here. Tell the good folks where they can get more from you.
They can reach me at go.bubbatrading.com. That's something new. Go.bubbatrading.com. If they have any questions direct, they can email me at bubba@bubbatrading.com. And I've written 2 books on options, and if I'd like to offer it to your audience, if anybody would like them, all they do is email me at bubba@bubbatrading.com, and I'll send them the PDF files of trading options.
Perfect. Definitely check out those books. There's a backspread idea that folks don't often think about that they really should. And that, ladies and gentlemen, is Todd Bubba Horwitz. Thank you very much.
Ilya, thank you so much. It's great to be with you.